Hello. Good afternoon, everyone. Thanks for joining us for a very exciting and interesting session in our KoreSummit Real Estate series. And today we have a distinguished panel of speakers with tremendous experience in the real estate markets and tokenization and secondary market operations. And what we have here today is to really discuss and understand and listen to the experts on what private real estate shares are and why tokenization is so critical and important, and what does trading in these markets really mean. My name is Kiran Garimella, and I'm the Chief Scientist and CTO for CoreConnex. And I've been in the capital markets for more than 20 years, both as a private trader myself and writing all types of algorithms. And at CoreConnex, I lead the strategy and development of blockchain-based solutions for the permissioned capital markets platforms. So, with no further ado, I would call on Peter Daneyko, James Dowd, and Lee Saba to just say a few words of introduction, and then we'll get right into it. Peter?
Sure, maybe I'll jump in. So I'm Peter Daneyko. I'm the CRO over at KoreConnex. And we focus primarily on the primary marketplace. So this discussion is going to be, I think, extremely invaluable when we say, what do shareholders do when they move from primary to the secondary trading side of things? And what's involved with the regulations and associated with that. So I'm looking forward to this panel, especially with Jim and with Lee, because as we segue from the primary, what are the liquidity events that are actually going to occur and transpose? And I guess what's the state of the union? So I'm going to welcome my co-panelists here and looking forward to the session. Thanks, Grant.
Thanks, Peter. Any of you want to go? Jim, maybe?
Great. Thanks, Kiran. Thanks, Peter. I'm Jim Dowd. I'm the founder and chief executive officer of North Capital. We are a registered broker-dealer and fintech company, and we're focused on the full life cycle of exempt securities. So from primary issuance to clearing and escrow and clearing, secondary trading, and custody. And as Kiran said, there's a lot of the interest in private markets and activity in private markets is really focused on the real estate sector, and we've found that to be a very significant part of our overall business for the past 10 years, and very excited about some of the things that are happening with tokenization and the potential opportunities going forward there. I should also mention we're a partner of KoreConnex and work closely with them on some of the services that we provide kind of hand in glove with their technology stack. So delighted to be here. Thank you for having me.
Thanks, Jim. Appreciate it. Lee?
Thanks, Kiran. And thanks, Peter. Hi, Lee Saba. I oversee market structure and technology for Rialto Markets. We're also a FINRA broker-dealer, similar to Jim. And we help on the primary side of private issuances as well as the secondary trading with our alternative trading system. I was just trying to do the math in my head. I've forgotten so long, but it's been probably closer to 30 years. I was thinking it was 25 in financial services, and I spent the bulk of my time on the buy side or the asset management side, running electronic trading and that infrastructure. I also co-chair the fixed trading community, which is a global protocol standard that allows us to trade or creates a standard for the trade life cycle. So from IOI to settlement and everything in between, that's what fixed stands for. So thanks, KoreConnex, for having me, and look forward to the call.
Awesome. Thank you for that introduction. What we're seeing lately has been over the last several years, a lot of talk and discussion and interest around tokenization in the real estate, right? I mean, real estate has been around for a very long time. REITs have been around for quite a long time. So I'm kind of curious to see your viewpoint on what it is in today's environment that tokenization and liquidity is becoming sort of critical, and why tokenization, especially for the real estate markets. Would love to hear your view. And Jim, you alluded to this in your introduction, so maybe you can start this.
Sure. Well, I think from my perspective, the big innovation in the market that has taken place really since the passage of the Jobs Act in 2012, and then the regulations started to get promulgated in 2013, 2014, was the ability to fractionalize individual investments in a way that previously wasn't practical from a regulatory standpoint and from a kind of a technology and logistics standpoint. So when we kind of started to engage as a wholesale provider in 2013, 2014, our earliest clients were actually real estate platforms that were focused on taking individual projects and then fractionalizing them for retail investors, family offices, small institutional investors. In fact, one of our clients kind of coined this term of small balance real estate to kind of describe this whole middle market part of real estate that was sort of too small for the large funds, too big for individual investors. And so that fractionalization, became a pretty significant driver of access to new capital. And just to kind of close the loop and answer your question directly on tokenization, I think tokenization is that next iteration, that next generation technology piece to really enable the settlement and secondary trading and kind of open standards for future activity. And that's why it's so exciting, is we've never had open standards around private securities, and it really creates the possibility of doing that in the future.
Awesome. So, Lee, you are in this unique situation of not only looking at the primary, but also facilitating the secondaries also. So, I'm kind of curious to see, how you see this whole sector taking off and evolving, and what are some of the challenges that you might see for secondary market trading in tokenized real estate on the secondary market. So, some views on that, if you don't mind.
Sure. Yeah. No. Thanks, Kiran, for that question. And I think Jim hit it on the head with the fractionalization aspect of these assets is key. If you have a property in Malibu and it's worth quite a bit, and you Airbnb it, and it's now wrapped in a Jobs Act security like a Reg CF or Reg A, possibly a Reg D. Now the wider audience can get access to the proceeds from that. They can, really take advantage of unique assets and add them to their portfolios. Even in a retirement account method. So it's very fascinating. It's a good time to have a front seat in this space because it's evolving so rapidly. So we're really excited, and like I think most of you guys too, we've seen a lot of real estate projects come our way, and it just seems like a nice fit right now for leveraging Jobs Act, for leveraging fractionalized assets, and then I guess tokenization, which to me, tokenization is very exciting, but it's an operational efficiency more than anything. It allows us to move forward a little bit faster, a little bit cleaner. We still do have a little bit of hurdle though, as we all know, because some of the regulators aren't enamored with permissionless blockchains being the single source of truth, and that's why we need partners like KoreConnex to keep the cap table true and work with your technology, which I know, Kiran, you remember the long hours we've spent integrating for primary and more importantly secondary market trading, which does take a long time to actually integrate. But now that we've figured out that path forward, and leveraging Hyperledger, which is a core tenet of KCX, the efficiencies are tremendous. So we're excited for the tokenization aspect of it, but you have to make sure that you have an on-chain and sometimes an off-chain representation of those assets.
No, absolutely. Thank you for that, Lee. I mean, you and I and a few others on our teams have had long conversations around, how to make all this happen. And, it's all there. It's all ready. We've done the bulk of the work there, right? I mean, that's the exciting part. And you're 100% right. What do the level two off-chain solutions look like? So we have some interesting ideas on that front as well. But I just want to switch gears a little bit. And Peter, you talk to a lot of issuers, a lot of clients, a lot of partners, especially in the real estate space. What is your sense of adoption of tokenization and being, open to this idea that you see from real estate, clients and issuers out there?
Yeah, thanks, Grant. So I think we're still at to a large degree this educational front when it comes to even the term tokenization. And as Lee and Jim alluded to, that there's one thing that hey, I can fractionalize all these assets from a token perspective, but
Mhm.
how does it? How do I remain compliant? I mean, Lee just mentioned when he talked about Hyperledger Fabric and a bunch of technical terms, and okay, so that's on a blockchain. There's permission and there's permissionless.
Mhm.
So I think from it, we're still at that educational front. So when it comes to real estate, they go, hey, I want to tokenize this asset and I want to put it out on uh, out into the universe or the ether, and I want it in my wallet and I want it in my pocket, and I think that creates a lot of if we
Looks
take
like
a step backwards and say,
oh,
if everything starts with regulations,
mhm.
and what are those regulations, and if I tokenize an asset, and how do I tie them together with the regulation, and where do they go from there? Just a comment on that. What we're seeing in real estate is, so a lot of companies say, I want to use a Reg A, for example, and I'm dealing with the primary, and I'm going to tokenize this. And as Lee alluded to, we're going to fractionalize it in smaller pieces. But at the end of the day, it's just a security. The efficiencies of putting that security on say, a permissioned blockchain just allows fluidity and efficiency. But I think a more interesting comment I'm getting from real estate projects is, if I'm doing a Reg A offering, what's the future with this? And I'm referring to the liquidity future and dovetailing into secondary trading. And even secondary trading might be at a nascent stage. The foundation and the footprint is there from that ability to digitize them and have a ledger and understand that who's the shareholders, who are the stakeholders, who are the custodians. But more importantly, if I get into a Reg A offering, that liquidity event exists. And that's what we're starting to hear. So more investors are looking at, maybe I don't have to hold this for the next 10 years. The
Mhm.
exemption itself affords this ability the ability to transfer. The technology ATS platforms are now facilitating that ability for me to at least have that secondary liquidity event. So I think that's creating an exciting time for that investor to at least realize that I don't have to wait for a traditional IPO and M&A, something of that nature, especially when I'm involved in an asset class that maybe I'm not dealing with, a REIT where I'm not getting a quarterly or annual revenue
Mhm.
income stream from that. So if that kind of answers your question a little bit, what I'm hearing on the street is the regulations first is, once I'm educated, I do have a nice liquidity event. And what is the ATS? So that's the big question now. People are saying, when does that occur? How does it occur? And companies like Jim and Lee's, where, they're addressing that, And so we go from the primary to the secondary. And I'll turn it back to our other panelists in that regard. But yeah, the education and the appetite is it's an exciting time. Again, the investor, myself included, I go, hey, I have some options in the future with these types of assets.
No, no, absolutely. Um, ever since reggae, the Jobs Act, obviously, right? But reggae in particular, took off. It took off across many many different industries and sectors. I just want to get a view of how much more traction are we seeing. What are the perceived advantages of reggae in particular, in the real estate, and what impact is it making, both from a primary perspective, and Jim, if you can address that portion, give us share your wisdom on that one. And Lee, if you can then piggyback off of that and just share with us your insights on why you think that's so attractive, especially for reggae.
Mm-hmm. I mean, I think there's two aspects to reggae specifically that are attractive for real estate and for other kind of, let's say, call them frontier alternative investments that have kind of individual series or individual share classes. The first is that as you mentioned, reggae has federal preemption kind of out of the box in terms of being able to sort of offer nationwide, to most investors, not just accredited investors, and then have immediate liquidity in the sense that the securities that are offered are not restricted securities. So that's kind of uniquely available to Reg A. With Reg D, you still get some preemption, but you have to do notice filings. With Reg CF, you get preemption, but you have sort of investor limits and the securities are restricted. But with Reg A securities, you could literally, provide for the offering, have it set up for trading, very soon thereafter. And all of the primary offerings that we have listed on our ATS are all Reg A securities that were basically designed with that in mind. So not only did the sponsors kind of take the steps to get them listed, but they actually conceived of their entire business around this idea that liquidity would be an important part of that exempt securities life cycle.
There's one thing I want to double click on that, Jim. With the reggae itself is very good, it's popular, we get that, right? But in addition to that, are you seeing a lift in interest and capital raising because of tokenization in particular in real estate?
Yeah, it's an interesting question. We did very much in sort of the period 2017 to 2019. And then more recently, I think it's been a little bit of a mixed bag, in part because of, I wouldn't say it's like regulatory uncertainty. I would say it's more, regulatory hostility, that if you have a deal that's a high quality deal that you can raise money without tokenizing, then you're just kind of buying into a heap of trouble if you then sort of mention blockchain and tokenization. I mean, even to the point where we've had some customers who basically took an offering, took their 1A to the SEC, had extensive comments back related to the tokenization portion, and then sort of redacted that and proceeded with a regular type offering. So that's not the fault of the regulators. It's not the fault of the issuers. It's kind of, I think, a byproduct of the fact that there have been so many grifters and fraudsters kind of permeating the crypto market that it's really, pretty much destroyed, a lot of the kind of enthusiasm that kind of took hold in 2017, 2018. And I think now we're kind of at a point where it's going to take some time to rebuild that trust. I mean, when FTX first came out, I thought it was going to be like a year. Now I would say it's sort of 2 years at a minimum.
Yeah. And interestingly,
FTX is the new 4-letter word.
No, that's right. I mean, in one sense, right, when we talk about this internally also, we sometimes think FTX is probably the best thing that happened because it brought to the front, it's highlighting all the issues. And then, by contrast, almost, it is saying, here are all the good guys who do these things in a very compliant way. I mean, and that is the right way to go about it, right? So,
now, can I touch on that? I think that's an important distinction between what's going on, with this team, the folks on this call, and what was happening in FTX general crypto world. I mean, we're in regulated markets, right? There are investor protections. There are silos of what you can do and what you can't do and what you have to hand off and what, so, between, the trading system, between the payment rails, it's not our bank accounts, it's the investors' bank accounts. It's the cap table management and the registered transfer agent that KCX handles. Like, though they're the official owners of the books and records, so all of these segmented things that have been built heuristically over 100 years plus,
Mhm.
have got us to this point. And you just don't throw the baby out with the bathwater, right? It's like, oh, we have crypto here. The hell with all those old rules. It doesn't matter anymore.
Right.
No, those were built for a reason, and we're figuring out ways to apply the best in the latest technology stacks, which is DLT and blockchain, but also not forgetting how we got here and playing in a compliant way. So I think that's where the magic is, and I think that's where we all sit in very well, to make sure that we're not the next FTX whatsoever. This is a completely different universe from what those guys were doing, and some others that are still around. So,
Oh, no, absolutely. And if you look at the primary investment, the intake on the capital raise side of it, right? You all, obviously, highly reputable, FINRA registered, very highly compliant organizations such as yourself. You onboard the investors and you perform your compliance activities. So there's a lot of attention, there's a lot of rigor, due diligence performed on that side, right? Now, when it comes to the secondary, especially in a tokenized world, like you pointed out, Lee, many people have this impression that, hey, it's tokenized. Now I can do peer-to-peer, transfers and trading all by myself. I don't need anybody
no,
else, right? So
that's false. That's 100% false.
I know it is. I know you're just waiting to jump on that one. But so from your secondary viewpoint, right? Just walk us through some of the protections and compliant mechanisms that you have built, and we have all built together. They'd be very useful for people to understand why those things are in place and why you really cannot be doing a free, peer-to-peer trading all the time.
Well, number one, if we're dealing with U.S. or North American related securities, it's a privilege to own securities in the U.S. or Canada. Like, you have to be approved to own them, and that's number one. It's not just a free for all crypto. Anybody, anywhere, anything goes. So running Know Your Client, which is also known as KYC, or AML, which is anti-money laundering. Those give us the protections. And by the way, not everybody passes those. As we've all seen, there's folks that come into the ecosystem that are just not eligible to participate in our private markets here, or in our markets in general, even the listed markets. So, that is the first and foremost, the first protection. But before they get into a trading realm, we also have to make sure they have, tie them into a banking or a payment rail. Make sure that, you can't pay for secondary trades with a credit card. You have to have some form of, wire or ACH functionality behind the scenes. We're always trying to assure that, the trading is going to settle. So when you put your trade in, we make sure, and again, working with, folks like KCX, we make sure that that if you're selling, as a seller on the ATS, you actually have the shares to sell. If you don't have them, you can't put the order on, right? So that's actually a slight advantage to maybe some of the publicly listed companies or workflows, but that's a whole other ball game. And then the same with the banking rails, right? We can ping and see how much money you have as a buyer to make sure you can cover the position that you're trying to do. Once all that criteria is met, we can cross, and again, these are ATS crosses, or alternative trading system crosses, which are matching engines for the most part, and then we're off to the races. We start messaging back and forth to again, KCX, for example. Hey, move from Peter to Jim, and then make sure you pay the other side as well. So it's pretty efficient. It's not brain surgery, but plugging in all those wires and making sure that they satisfy all the regulatory requirements is the key.
No, absolutely. Peter brought up this question or a viewpoint that as an investor would love to see a market for liquidity, liquidity market out there for our tokenized real estate, shares. And me too. I mean, I'm an investor myself. I invest in, many of these things myself. And, yes, that is for us a very compelling argument. I'm just kind of curious, though, Jim, from your perspective, as you talk to issuers themselves, and how do they view the advantage of having a secondary market and their ability to attract more investment because of that advantage.
Well, I think that's exactly the calculus that those investors, consider. I mean, if you think about it from the perspective of an issuer, the issuer is really interested in one primary goal, which is to raise money for their offering. And so, if there are, features that can help them do that, either by providing the promise of liquidity or by creating custodial solutions to kind of expand the universe of prospective investors, by providing diligence and supporting material that might attract professional advisors that might not otherwise, look at the offering. Those are all factors that are going to expand the universe of investors. And in the early stage of tokenization, a lot of the promise was this idea of kind of instant globalization, because you could take an offer. If you think about, a lot of domestic real estate deals are, originally they were sort of marketed at the country club, and then you've got general solicitation with the Jobs Act and Reg A Plus and Reg CF, and now you can kind of sell the offerings in a very public way using traditional digital marketing. And then tokenization was sort of like taking that to the next degree, which is not only accessing investors that you kind of solicit through general marketing, but kind of taking that to a worldwide network. And so I think it's all about how to attract more capital and make it more viable for that capital on a long-term basis. So it's all about reducing the friction and expanding the addressable market.
No, absolutely. Peter, do you have any view on this?
No, actually, I got a couple of questions that I think Jim and Lee can shed some insights.
Mhm.
So when it comes to, Jim, you made a comment about going from the primary to secondary, and in the real estate side of it, those issuers that actually plan that up front versus I'm going to do a Reg A offering and I'm not really thinking about my secondary. So they may be missing the opportunity to educate the audience and get them more enticed to make that investment. But the success of those, as far on the buy sell side, what's been your experience with that? And both to Jim and to Lee, like as far as if I plan it up front, I'm doing a Reg A offering, my books are clean, I've got a registered TA, and when I jump into the secondary, what's been the experience that where's the reality check? What's been the experience for those kinds of companies? Do they have enough buy sell, or is it still nascent? Are we early adoption? Maybe both you guys can give me your insights on that.
Sure, I can take a stab if that's okay, Jim. If you don't mind me going first. Yeah, I think about these markets is very simplistic in some terms. Is on ramps and off ramps. The on ramp is the primary function. Folks buying into the real estate project or whatever other project it is, getting on the cap table, everything's legit, walking through the whole AML KYC process. But then we have an off ramp, and the off ramp, which could also be an on ramp in some ways, is the alternative trading system, is the matching functionality.
Mhm.
And I think that some of the feeling that I'm getting from issuers is that, in just reading the marketplace in general, is that why wouldn't you want to have an off ramp, for your issuer, right? For your issue, it provides some form of investor protection in itself, because if you get into the position and you don't like it, you have an exit strategy. If you like the position a lot, it gives you the opportunity to buy more after the primary. So it's a very positive thing all around. And I guess the other thing I wanted to mention is, there are liquidity profiles, and Kiran and I have talked at length about this, but not liquidity isn't guaranteed for anybody, even on New York Stock Exchange or NASDAQ. And there's quite a few, if you look deep, of stocks that are listed that don't trade. They don't have any liquidity either on those exchanges. So, it doesn't mean that you're going to get liquidity if you just go to New York or NASDAQ. But just back to the liquidity point is if your issue had 500 investors, you only have potentially 500, 499 other people that can possibly, buy your asset. If you have 100,000 issuers, investors, excuse me, you have a lot more. You know what I mean? That can potentially throw their shares in, for to create some market. So you got to think about it like that. These are private, small issuances. A lot of times with not as many investors as you think. Some have a lot of investors. Some have 1,000 investors or less. So you have to kind of know where you're going, which I think gets into some of the ATS principles that we can talk about. These are not, I don't think, sometimes the central limit order book method where, continuous markets is a good theme where people can get in and see the spot and go. Others might require more of an auction type or a point in time cross where, you aggregate your liquidity over a period of time. So, maybe you have a weekly cross or a monthly cross or a quarterly cross to aggregate that liquidity and find the buyers, find the sellers. They all go in on the second Wednesday of every month between noon Eastern time and 1. And at 1:15, you understand what happened. And I think those are, the kind of some of the profiles that you can think about when it comes to secondary and liquidity.
Isn't that how most of the markets actually evolved? They had these market fairs, right? From the times of the Medicis, they all got together at a certain time. And no, I mean, it's fascinating because that's how all the public markets also evolved too, right? I mean, this continuous is something, it's a new phenomenon. But to make this successful, right, both on the primary issuance side and also for secondary, how do we make these, how do you make the market aware that all these listings are out there? So what mechanisms do we have today? Unlike, you look at a lot of the press and the noise out there in Wall Street, Bloomberg, Mad Kramer, whatever you call it. Most of that is in the public market. So those are well served by current traditional, media outlets. So what do you think would take to get this sort of attention and awareness building up in this in our space as well?
I mean, I'll take a stab at that. I think that question is really at the core of a lot of the work that we and others are trying to do to, create more open architecture infrastructure. And we've talked with other ATSs in the past about creating sort of ATS networks to be able to sort of exchange orders and exchange order flow and try to aggregate the size of the market. And it's hard because basically everybody's got a slightly different system. I mean, I don't know if you took it, all the order types that Rialto has and the types of orders that we have on the PPEX ATS, if they would actually line up 100%. They probably get 80%, but maybe not 100. And I certainly know that some of the other ATSs that are out there are not kind of looking at all of this in quite the same way. So I think it kind of underscores the importance of having interoperable systems because even in the platform markets, after the Jobs Act, what sort of developed is a lot of kind of siloed platforms. So you go to your real estate crowdfunding platform, you go to your small company, startup company platform, you go to your secondaries platform, maybe there's a collectibles platform over here, and everybody's kind of got their own market niche. And currently there's not a lot of overlap of investors between those different platforms. And I think that until you sort of solve that problem, you're not really going to get the kind of the crossover that will really lead to more robust markets and deeper markets, both on the primary and the secondary side.
Yeah, no, absolutely.
And if I may, Jim, do you think that's a big part? I mean, we're still at that educational stage. I mean, certainly further along, because if we look at the raw numbers of the number of companies that have decreased when it comes to the public marketplace, I mean, there's, I don't know, I've heard numbers as high as 50% reduction in publicly traded companies over the last 20 years from what they used to be. Yet the capital influx is in the 6 to coming up to $10 trillion in the private marketplace. Do you think that the marketplaces and the consumer marketplaces and the awareness over time, I guess that's what we're all looking for, is going to evolve and say, hey, I'm investing over here, and just through osmosis, it's just naturally going to grow based on this education and based on where's the money and how do I get out of it?
I do. I mean, I personally think that the main difference between kind of where private markets are today and where public markets are and where private markets will be in the future is the passage of time. Because really, if you think about it, the reason it's not like people or companies are leaving public markets because they think public markets are bad or inefficient. It's because they're incredibly expensive. And if you think about the cost of doing an initial public offering and then maintaining a public listing versus the cost of doing a Reg D or a Reg A plus offering and then listing it, either immediately or a year later under Rule 144, it's a fraction of the cost. And so if you think about, like, on the one hand, you have this, public market where it's becoming, more expensive, more highly regulated, more driven by a lot of factors that really don't derive value. I mean, think about the number of solicitations you get from trial attorneys, kind of soliciting you for lawsuits because, of an allegation that somebody, did something that might have impacted the stock price. Think about that versus private markets where basically it's like, there's just not a lot of that sort of noise, and the cost and the overhead is a lot less. So I think if we had infrastructure that basically worked as well as in the public markets, I think that the private markets would end up supplanting a lot of the public markets, except for the top, maybe the top 500 companies.
Wow. And I do have a follow-up question on that one, and that is, but before we go there, let me table it for a second. I just want to address one of the questions in the chat that's come through from Laura. And the question is this: what are your thoughts on collateralizing real estate security tokens for liquidity? And are you seeing anything out there around this topic? Jim or Lee?
Sorry to read through the question. Yeah.
Shall I repeat the question?
I can see it actually in the chat.
Yeah.
I don't. Let me think on it. I don't have an immediate response.
And the reason I start for that particular question is that when Jim, you were talking about your views on this, it just struck me about private markets supplanting the public markets, but specifically with real estate. What do you think will happen as we go forward? Will the private markets not only just supplant the public markets, not eliminate them entirely, obviously, but take a much broader role, but will they also facilitate more innovation in the types of tokenizations? Collateralization is one good example, and there could be many others like that, which is a lot more innovation than what is probably available in the public markets. Any thoughts around that?
Well, I think it's easier to iterate and to innovate in private markets than in public markets because we're in private markets or exempt markets are kind of they're more of a disclosure market than a kind of a merit market or an approvals market. I mean, even with Reg A plus, I mean, the SEC doesn't actually approve an offering; they allow the offering to go forward, and that's kind of the hallmark of the private markets is you can, you as an issuer, you can pretty much do what you want to as long as you comply with the general disclosure requirements under Reg D and you follow the rules. So I think that for that reason, most of the interesting innovation that we see, is at least kind of road tested in private markets before going to public markets. And the exception is if there's some type of asset or some type of structure that really relies upon broad-based retail distribution, in which case it's not really practical to do that in exempt markets. So I do think we'll continue to get more innovation and more experimentation in the private side. But there's just you kind of have to understand, or people, the issuers must understand, there's kind of limitations to that as well, because there's certain types of restrictions that exist that are going to kind of limit the ability to experiment and to attract the number of investors that you might want to attract, et cetera.
Okay, very good. Lee or Peter, do you guys have any thoughts around that?
Just to Laura's question on collateralizing real estate in security tokens, isn't the single biggest friction point there right now today is land titles? I mean, it's really easy to start with the clean approach if I'm doing a Reg A offering on a real estate offering as a security, but trying to, how do I unencumber this asset, both from a technology perspective and from I come back to the land titles things. How do I break this up into pieces? And if the infrastructure isn't in place to that, is that one of the biggest holdbacks for existing real estate assets that I want to say tokenize? And then even if I'm utilizing the regulations, comments on that? Is that kind of an accurate assessment to say we've got this logjam there? Or it's just a lot of government bodies in different jurisdictions throughout, wherever those real estate entities reside?
Or is there a logjam? Is it a significant issue?
Is it an issue? I guess the fundamental question I want to ask Jim and Lee's experience is say, okay, I've got a building. I'm going to break up my building, and I just want to. I guess it really depends on what the ownership structure to begin with. Have you seen anything in that arena from a real estate perspective, Jim and Lee?
I mean, I've seen some. There's some innovative new companies out there leveraging blockchain around, the authenticity of some of their, the reports around land titles or real estate titles, around safety reports, around elevator maintenance, around whatever it might be, where the blockchain is holding the single source of truth for that particular asset at any given time. So if you're interested in that asset, you can see that all of the, and again, I'm not a real estate developer. I don't, I don't know. This is just kind of, what I've seen, but what you can validate that is the single source of truth, and it's the latest updated version of everything that they have. So again, if there's like a fire inspection, if there's a land dispute, if there's a lien against the property, if there's, any, I don't know, maybe asbestos in the building, that it would be all recorded in this, attachment on a blockchain that would be tied to the asset, so that you can actually understand exactly what's going on with that real estate investment at any given time. And it's updated all the time from what I understand.
I was just going to say that I think that the issue that you raise around, diligence and disclosure, blockchain is great at sort of creating a permanent, timestamp record. A lot of times it's referred to as immutable. I prefer the term audit proof because basically you can make changes down the road, but all of the previous changes are recorded as well. And a lot of financial systems don't have that, kind of out of the box. But I think with the actual, kind of underlying information has to be accurate for the blockchain to really add a lot of value. So, I mean, unless you have kind of trusted gatekeepers who you trust with providing that information in the blockchain, the fact that it is in the blockchain doesn't make it any better than it's on letterhead that you created in PowerPoint, right? I mean, there is a question of there's authenticity. There's a value to blockchain to be able to prove authenticity, provided that you trust the source that's then seeking that authenticity.
Yeah, you hit the nail on the head. Absolutely. Yeah. Sorry, Lee.
Oh no, I'm just emphasizing what Jim was saying. Junk in, junk out. If it's bad data and it gets stamped into the blockchain, it's still bad data on the blockchain.
I think the same thing is true with respect to tokenized securities. I mean, one of the issues that we ran into in sort of 2019, especially, is that people would take these offerings, deals that in the traditional securities market, you wouldn't want to go near with a 10-foot pole. And then they would sort of sprinkle, crypto blockchain dust on it and think that it would turn it into a, high quality offering. And the reality is exactly what Lee just described. It's like, unless blockchain can add value to an already good deal, but it's not going to turn a bad deal into a good deal.
Absolutely. I mean, IT folks have a standard terminology for it. It's called the GIGO principle, garbage in, garbage out, right? It's a well-known thing. And, surprisingly, Florida seems to be at the forefront of some of these innovations, right? I mean, the SEC's standard for what constitutes a security is the HOVE Act. And that was at the Orange Grove real estate issue right here in Florida, of all places, in my neck of the woods. And also the very first NFT for a house was done, I think, last 2021, 22 February. I forget the exact date now, but it happened in Tampa right here. So, it's very, very interesting. No, this is, we're seeing a lot of innovation. We're seeing a lot of uptake on this one. But I think one of the hallmarks, people, us, this type of a forum is to help people educate and really come to grips with understanding, how to deal with this market. By the way, do you, Lee, Jim, do you guys work with any third-party reporting providers? What are the requirements for that?
I mean, we do on the secondary side specifically. We work with a company called Guard, and we're, in full disclosure, we're also an investor in the company and help to found it. But it's a separate entity that runs independently and works with a number of ATSs now, and that's for the blue sky compliance and Rule 144 compliance that's associated with secondary trading. So Reg A Plus is an example. You get a federal preemption on the primary offering, but you don't get preemption on secondary trading. And so Guard helps with that blue sky compliance, and same sort of thing under Reg D. So that's one group that we use, and we're increasingly starting to kind of build out that network of data providers. There are some groups doing some really interesting work in terms of data aggregation on pricing and transactions, and our hope is that will continue, because again, having that interoperability is really key to kind of growing the overall market.
Yeah, if I can make a comment on that too. You brought up a really good point when you said, there's Guard, there's Trade Check. When it comes to that, from the primary to the secondary, I think a lot of people don't realize that the primary exemption on a Reg A, for example, when I'm doing, I'm clear to do my offering through all the states. But when I go to that secondary market, I think people have to recognize to say, and this is what we're talking about, you're not covered in the blue sky. You have to go through the blue sky states and companies, Trade Check reports, Guard reports. Basically, it's that extra bit of paperwork that you need to go through and make sure that you can go on the ATS, in that regard. So I think it's really, really important for the issuers to understand, hey, wait a sec, I did my primary, what's going on with my secondary? And again, the Trade Checks and the Guards reports are to facilitate that, to make sure that we can actually trade on the secondary. Pretty accurate there, Jim?
Yeah, I think so, and it is one of those things where it's definitely it's such a new market, and it's great to see multiple competing solutions there.
No, it just shows that it's evolving, and I think there's some growth there, that's occurring. Not to weigh in
for sure. It is evolving for sure, Peter. And I think just to kind of add on to what Jim was saying, I think what you're alluding to. But there's also CAT reporting, there's ORF reporting. These are all very standard securities requirements that have to go out and to the regulators in various routine processes. So blue sky, like the Guard product as well, is a big deal in private markets. And the other thing that I think is important to this, and I don't know, it's kind of off to the side a little bit, but is the security IDs. So, if you can get a QSIP, a CDOL, an ISIN, a FIGI, whatever it is that lists this across the universe. So if you have an institutional investor and you're playing around with a Bloomberg terminal, you're going to be able to look up any of these assets, for a QSIP, which is actually the number that gets traded. You might throw IBM in the symbol field, but it's actually the number in this particular tag that is unique across all the electronic venues that executes that order. So these private securities also get that same rigor involved. So it's I think and maybe even back to one of the earlier questions, this is the type of stuff that you're going to get liftoff from the institutions, because they're going to be able to easily plug into this. They're going to say, oh, look, there's an issue. Where is it trading? Oh, it's on Rialto. Oh, it's on PPEX. Oh, it's and then they can route directly to one or the other to get that form of liquidity.
You hit one key differentiator between the private and the public marketplace, and it's the ability to have news dissemination that's unified. And if you look at the public marketplace, it's the stock symbol. I can put a stock symbol. It can be replicated through all the news wires, etc. Nothing really exists properly in the private marketplaces. Yeah. As far as that unique identifier, you talk about QSIP or whatever it might be, but the news agencies don't pick it up the same way. It's just, we've done a lot of research and homework in that category, and it's just interesting if you had unique IDs for private companies that the infrastructure from news dissemination would allow anybody to, hey, I'm doing a private offering, and it's actually getting picked up. I think that's going to create significant mass awareness to the public at large.
No, absolutely. I think that was one of the final things that would really make this the whole market very successful, right? It's one of those indicators. Can I punch the name or the symbol of a private company, and through whatever it is, Yahoo or anywhere else, right? You can actually see, even if you compare two different news sources, you'll see the exact information. I mean, that is the nirvana of maturity in the private markets. So, I mean, we went through the complete sort of the life cycle, all the way up to the news wires and dissemination of this information. I'm kind of curious about on the front end of the intake side, and this is sort of the final question. If both Jim, and Lee, you can address this one. What do issuers need to know in this real estate marketplace for offerings like this in our space? What sort of special preparation or onboarding that they should be prepared for?
I guess the way that I would answer that is that they should have a very clear idea of who they think their prospective investors are, because that will make a difference in the type of offering that they choose and the amount of money that they have to spend to kind of access those investors. And then related to that is a plan for ongoing compliance. So if they're offering under Reg D, which is the most popular exemption, the rules are a little bit different than for Reg A Plus or Reg CF or or other types of exemptions, and just kind of planning and budgeting for that work, I think is critically important. We've seen a lot of people in the past try to do things and take haircuts on or shortcuts rather on relatively important matters like ensuring compliance on the secondary side or cutting corners on their offering documents or whatever. And I think kind of mapping out a plan for the offering is probably the most important aspect that I would suggest that issuers try to do ahead of time.
Very good. Thanks, Jim. Lee?
Yeah, I think the number, I guess you said issuer, right? What's the number one thing for issuers to consider? I think if you're going out loud, it's with your issue after you've been compliant, you've got your Reg CF and Reg A paperwork in hand, mm-hmm. You're ready to go. I think one of the biggest determinants I've seen of success is your marketing and very targeted marketing. Know your audience. Jim mentioned this. Like if you're not. If your audience isn't aware that these are available, again, these are slightly smaller security offerings. You have to attack your clients, your potential investors, and make sure that they're very aware of this process. That is huge. compliance number one. Number two, know your audience and know where they lurk and know where they're, what resonates with them. And I think that usually is a sign of, that's where we see the most success in offerings. They tend to meet their minimums and beyond.
And just to give a plug to our hosts, I think, get trusted partners, who can help you not waste time on things that you don't need to be an expert on if you hire the right experts.
Absolutely, right experts, and really make sure everyone is following the, they're 100% committed to acting in full compliance with all the regulations, right, and a code of ethics, all of that, great stuff. So this has been fascinating, and I really appreciate, both of you, all of you gentlemen, taking your time to help us and our audience understand this exciting space. I mean, real estate has to be one of the most exciting and going forward very profitable areas to be in, and what issuers can do to get ready for it. How should investors be looking into all of this? It's great. So thank you for sharing that. James Dowd, CEO, North Capital, Lee Saba, CTO and Head of Markets at Rialto Markets, and Peter Daneyko, Chief Revenue Officer at KoreSummit. And let's see if there are any closing thoughts. I'm not sure if Oscar will be jumping back.
Thank you. Thanks for having me.
Thank you very much.
Yeah, it was a great panel. Thank you.
Absolutely.
Hey, James, pleasure.
Really exciting. Thanks again, James. Thank you, guys.
Bye-bye.
Thank you.
Bye now.